All right, we are at time. It is 11 a.m. for those that are in Central and noon for those that are in Eastern. So we will go ahead and get started. Thank you so much for joining us today. My name is Cameron Halcomb, and I support our Old National Investments and our entire private wealth division with marketing. And so we are so happy to have you join us today for Outlook 2024, a turning point. Super thrilled to have Dr. Jeffrey Roach with us today. He's the chief economist at LPL Financial. And so before we turn it over to him, I did want to just go over a few housekeeping rules. Please, as long as you are not speaking, we just ask that you mute your microphone, and this will just help eliminate all the background noise and make sure that everybody can hear the presentation. Additionally, we want this to be a very engaging conversation. So feel free to utilize that Q&A chat feature. It is up at the top of your screen. It's a little chat bubble. And so please put your questions in there, any comments. I will be monitoring that. And so we will feed those questions to Dr. Roach as we go throughout his presentation. And then additionally, I'm sure everybody will be very kind and respectful during our time together, but just as a friendly reminder to maintain a professional and courteous tone in all of our questions and comments. So I'm actually going to hand it over to Eric Pinter, who is our program manager for Old National Investments, and he is going to introduce our host. So Eric, I will pass it over to you.
Thanks, Cameron. Thank you, everyone, for joining the call. Good morning or good afternoon, wherever you're sitting right now. Before we hand it over to Dr. Roach, I just want to thank you for joining us. We try to do this once or twice a year. We want to make sure we bring relevant content for you, our clients, so you can learn a little bit about the markets, learn a little bit about the economy. And like Cameron said, please ask some questions, use the chat button, and ask away. So with that, I'm very excited to introduce Dr. Roach. You've seen him on TV, you've seen him in some quotes in some newspapers, and he's now with us live in person. So Dr. Roach, floor is yours.
Well, thanks, Eric. And thank you, Cameron, for the opportunity to talk economics. I mean, who will want to stay awake for talking economics? So there's always exciting things to think about. I will say, there's blessings and curses about being virtual. So, it's easy. I'm in my hometown, Charlotte, North Carolina. But the downside is I don't know, who's nodding off and needs some encouragement, to stay awake. I taught I had some Clemson football players when I was a grad student at Clemson and teaching, undergrad economics. So I did get used to people sleeping in class, but I like to keep it engaged. So just as Cameron said, would love to have this interactive. I'm going to highlight a couple of hot topics that I think you should think about in this world of investing. But I have time to highlight 3 or 4 hot topics. There's 1,001 hot topics. So definitely want some conversation. And I do webinars all the time for our clients, and it has turned out to be okay. We can do this. We've adjusted over the last 3 years or so to do webinars that are interactive. So Cameron's going to be tracking that, as she mentioned. And Cameron, you just pop right in whenever you have whenever I give you a pause, I guess is the question, right? I just keep on talking.
Sounds good.
So happy to do this. A lot of interesting things happening. We have our Outlook that's actually public facing, so you don't have to have any special logins. You can go to lpl.com and you see our blogs, see our weekly market commentaries, see our 2024 Outlook, and that's straight on lpl.com. So feel free to do that after the call if there's further interest. So we published an Outlook started writing it in October of last year. And as you can imagine, with things changing so quickly, writing something so far in advance, that's like a decade in advance. But I think we were capturing and we have captured what's at the heart of what's happening in 2024, where there's this dynamic between things that have been a permanent shift in behavior and activity, and then we have these things that are temporarily dislocated.
Dr. Roach, we lost your audio for a second. You might be muted on. Are you muted on your end? There we go. Oh, back to be muted.
All righty. Sorry about that. You
There
doing
we
okay?
go.
All right.
There
Excellent.
we go. We're good.
Well, so this temporary dislocation versus a permanent shift. That's where we are. Think of it this way. I've used this analogy recently, and I think it's helpful. A post-pandemic economy, which we still are in, we're still adjusting to this new world. A post-pandemic economy, I think, is eerily similar to a post-World War II economy. And the reason why I started thinking about that is after World War II, 1947, you had to go all the way back to 1947 before you had 2 consecutive quarters of negative growth and no recession, right? So in this world of hyper politicized commentary, we started trying to politicize even, what is 2 consecutive quarters of negative growth. It's true, it is true that 2 consecutive quarters of negative growth is not one for one a necessary and sufficient condition for a recession. 2001, for example, only had 1 quarter of negative growth, and we had positive growth again in the second quarter, Q1 of 2001, and then positive. So we've had recessions with only 1 negative quarter. We've also had no recession with 2 consecutive quarters. You got to go back to 1947 for that. Hence, I think to build the narrative, kind of help understand where you are. In economics, I'm 1/3 mathematician, 1/3 philosopher, and 1/3 storyteller, because I think that kind of helps, think about where we are. So think about 1947. Finished the war. We had a massive movement in capital and labor during the war. Labor force participation for women jumped way up, right? Then when the people came back, they were making decisions about what to do with the GI Bill. They want to go back into the labor force, or did they want to go and get an education? There is this massive shift, and I think that is what we're still seeing definitely in 2022 when we had negative quarters of GDP growth, this movement between labor and capital that has never happened to this magnitude recently since World War II. So if you don't remember anything, I'll leave you with this so you can chew on this and see what you think. It's a thesis, and you can see if this thesis needs to be debunked or if there's data to support it, that a post-World War II
Dr. Roach, it looks like we got muted again.
All right, here you go. I think Cameron, here's a thesis. I just put one thesis out on the economy. Here's a thesis. I think when you hit mute all for the audience, maybe I'm somehow getting in. I'll hit unmute. I'll just keep on hitting unmute if it pops up again. You can hear me okay?
Yep, I can hear you.
Excellent. Post-World War II economy informs ourselves about a post-pandemic economy. Let me tell you a couple things to think about, and this is why I think even in the face of headwinds, there's still opportunities from an investment side. First is the inflation, job market, and housing market dynamic. and I'll start with a personal story. Before LPL, I was at Visa, living in the San Francisco Bay Area. When COVID hit, we realized that, hey, it's not just this temporary, hey, we're going to work from home for a week or two. If you remember that back in March 2020, it was, hey, just maybe a 2-week kind of experiment. Realized this was long term. Well, I picked up my bags and my wife and 2 kids and said, all right, we're going back where we came from. I started my career at Bank of America in Charlotte on the corporate trading floor, which was everything that you would ever think it would be pre-Dodd-Frank on a corporate desk. But that's where I started. Most of my career has been in Charlotte. And after Visa said, hey, we're working from home, I said, hey, I'm moving from Silicon Valley to Charlotte, North Carolina. 2021 inflation rate for me, it's like negative 500. Because I had the ability to move from a very high cost of living area to a low cost of living area. Now, granted, not everyone could do that, but there was a fair amount of folks that could say, hey, we can decouple work with where we live. And it's not just extreme Silicon Valley to Charlotte. Some people did Silicon Valley to Lake Tahoe or some area even within state, but still the overall theme was the same. People moving from high cost of living areas to low cost of living areas. And I think this was very, very helpful to explain first this massive shift that supported consumer spending for so long, right? Because you think where we've been the last couple of years, inflation's been very elevated. It's going in the right direction now, but think 2022, think 2021. Inflation was quite elevated, yet consumers continued to spend. Why? One is because, in essence, a lot of people got bonused. They had an increase in discretionary income because people like me, I cut my housing costs to a third of what I was paying in Silicon Valley. That's extreme, but still the theme holds. And then, of course, the second, I think, reason why we saw inflation high and at the same time spending continued to grow on an inflation adjusted basis, no less, was the fact that you had this pent up demand, particularly for services. And I won't ask for a raise of hands virtually, but how many people went to Europe this past summer? Or somebody went to Europe this past summer. So even in 2023, the summer of 2023, there was still this catch up, people playing catch up in how they were spending their discretionary dollars. So spending for services, this splurge in kind of picking up for pent up demand was still a case. And I think it's important to think about this. You might say, well, wait a second. This reopening phase, started soon after the first round of vaccines. You could argue that, right? End of 2020, kind of a reopenings in many states, definitely by the summer of 2021. So what gives with this travel to Europe that we all did this summer? Well, Europe was a lot slower to have that transition, right? Accepting people in and traveling. I remember 2022 was challenging in some countries, and even the end of 2022. So I think what's interesting to think about is with the headwinds, we've had growth. So let's talk inflation. Let's talk Fed, and then let's talk what does it mean for markets. We'll certainly have conversation if we need to. And Cameron, any questions pop in yet?
No questions yet. So
All right.
keep them
All right.
keep them coming if you want to ask questions.
So thinking about a couple things. Of course, we need to talk politics. Not only the political risks with who's in the White House, but also with how the Fed responds to their opportunities in 2024 with rate cuts, potentially. I think the key to think about where we are here is we need to say, all right, inflation and growth are the two mandates for the Fed. So by Congress, Congress has said this is what you have to do. Your mandate is to provide an environment where you can get low unemployment and stable growth or full employment. So they're certainly concerned with the risk of a recession. We say, okay, well, wait a second. We talked about the whole point of 2 consecutive quarters does not make a recession. Let's have a little bit of an aside here and just review, well, what is a recession officially? The Fed does not define it. Congress doesn't define it. Whoever's in the White House doesn't define it. The official arbiter of the business cycle, the ups and downs, the contractions, the expansions of a business cycle, is in a nonpartisan group called the National Bureau of Economic Research. A lot of them are academics on tenure, right? So you could argue, well, we know how academia is politically, especially in the English and art department. But you could say, well, maybe the National Bureau of Economic Research isn't overly politicized. They define a recession, and they also give us the specific data points they look at for a recession. So it's pretty decently full disclosure, if you will. The necessary ingredients, I call them the 3 Ds. If you want to remember that, and alliteration can be helpful, can be confusing too sometimes, right? But the alliteration can be helpful. The 3 Ds. So what you need for a recession is the depth, diffusion, and duration of this contraction. Depth means you have to have a decline. It's not just a slowdown in growth, it's a decline in growth. Depth, diffusion, it can't be just in one sector of the economy like it was in 2022. It was inventories and trade. That was the only declining portion. It has to be diffused across the economy. Depth, diffusion, duration. Duration means just has to be more than a couple months. It doesn't have to be 2 quarters, but more than a couple months of depth, diffusion, duration. They look at real income, production. They look at job growth. They look at a number of sectors. You can actually go online and on their website, they'll explain how they look at that. Depth, diffusion, duration. We actually think that if consumer spending kind of gets to that point saying, hey, we've splurged on our travel to Europe, we've splurged on our services, everybody splurged on particularly durable goods spending right after the pandemic. We all had our Amazon apps ready and quick to go. Once consumers kind of say, okay, we've caught up to where we all the lost time we had when we couldn't travel, particularly, if that consumer spending number comes down and actually is on hold for a while, that could be the impetus of a recession that actually could happen in 2024. We still think that still has a chance of happening, even though we're definitely in the minority now saying, hey, things are going to be, great and we're in a strong economy. Well, yeah, there were certainly strong quarters in 2023, but we're talking 2024. And that's where the risk that there could be a slowdown. Now, granted, after the World War II, recessions are about 10 months in length. We think if we do hit recession, it'll be shorter than average and probably more shallow than your average recession. So Fed's on a mandate, dual mandate. They're at a point where inflation has clearly decelerated. So let's talk inflation just briefly. I hinted at my view when I told you about my experience moving from Silicon Valley to Charlotte, North Carolina. It's very important to remember 65% of households in this country are homeowners, meaning rent prices, leasing prices are not relevant. It's not part of their budget, if you will. So given the fact that we have such a massive part of our economy that's immune to the rise in rents, which has been a major talking point in a lot of mainstream kind of news articles, I think that helps explain saying, well, in practice, we're probably not feeling the inflation pressures as high as the headline number. So, for example, a little bit deeper, just talk to you about the idea of the vast majority of households that are homeowners, not renters. Take a step deeper, and that is, let's talk about the percentage of households that were able to refi in the last couple of years. Massive refining. By the way, Cameron, I did see a question come in, so I'll close this thought and then let you ask the question. In 21, 2022 even, but clearly in 2021, rates incredibly low. A lot of refinancing opportunities happen. So again, you could kind of argue to say even more of an irrelevance in housing related costs. Hence, I think it's completely fair for investors and market watchers to say, well, let's look at inflation metrics, but let's strip out what's imputed, meaning when you look at that CPI number, for example, a third of that CPI is an imputed measure by what would your house cost you if you are renting it. Well, that's a big if. We're not renting houses. We own a house. We refied. That OER, owner's equivalent rent, in essence is somewhat irrelevant for homeowners. Hence, you look at what the inflation rate looks like outside of housing. Now, granted, there's still 35% of the economy that is impacted by rents, but a majority of households in the U.S. you're just completely immune to rent. So, Cameron, you got a question for me?
Yes, this is coming from Emma. Are we currently seeing a slowdown in consumer spending compared to 2022 and 2023, or is this more of a behavioral prediction?
Yeah. So that's great. That's a good question because it was connected to what I had introduced the talk, saying, hey, what's a permanent shift, a permanent change, or a temporary dislocation in behaviors? So what I like to do, and this is very helpful, I think when you want to put this in perspective, a lot of times, not necessarily relative to 2023 or 2022, I want to say, well, what is the consumer doing relative to pre-pandemic behaviors? And so that's where, now granted, you also want to say, okay, well, the growth numbers, when you look at quarter on quarter growth rates, that's clearly relative to previous quarter. But on a levels basis, where are we relative to pre-pandemic? We are starting to see a little bit of a slowdown, even now, in, say, for example, the retail sales during the holiday season. So, specific answer to your question about behavioral changes, we often look at November to December as a block because Black Friday is not as relevant as it was, say, years ago, right? Even, I don't know about you, but in the Charlotte region, it seemed like there was a massive amount of kind of that holiday sales starting as early. I remember this because I put it down on my calendar, being a geeky economist that I am. November 10th. November 10th was one of the times where a lot of the stores just started saying, hey, here's our holiday sales. So the key is November to December, that 2-month chunk, what did it look like relative to that 2-month chunk of time in 2023? Slower, hands down, adjusted for inflation. Now it was decent, and we'll get a decent GDP report tomorrow morning because of holiday sales being decent, but definitely slower than the holiday period in 2023 and 2022. I know we got another question, Cameron, so let's take that next one.
This one's coming from Sherry. How does an election year impact the risk of recession or the economy in general? Might the economy hold steady courtesy of the incumbent who hopes for re-election?
Yeah, so we've done some analysis on that. You can see it on our blog. Can't remember if it was 3 or 4 weeks ago, but we went back to 1955. We just said, all right, let's look at what those at just S&P 500, made it real simple. Said, let's look at equity market returns when there's an incumbent, when there's more of a potential shift in leadership. And we've looked at all of those iterations. What's fascinating, we've actually starting to see this play out even where we sit today, near the tail end of January here already. And that is the first couple of months of an election year tend to start out slow. There's a slow performance, a little bit choppy, but by the end of the year, it's up. It's positive, even when you adjust for whether it's Democrat, whether it's Republican, incumbent or not, or re-election. it's a decent kind of low mid single digit kind of year. So which kind of continues to argue down that same path where, markets like a divided Congress. Markets sometimes are very quick to just look past the politics as long as there's, not a massive change in regulation, things of that nature. Now, we do know going into, say, 2020 election, a lot of trade-related chatter, a lot of, conversation with China, thinking about 2018, 2017, and that certainly hampered growth a bit. But from a market standpoint, from an equity standpoint, markets look past that, and election years are typically pretty decent years, although they start slow. Cameron, back to you.
All right. Well, thank you. We have a follow-up question just in regards to the holiday spending. Wouldn't the spending numbers be skewed for holiday sales and other consumer spending, considering everything is more expensive? This one comes from Cassie.
Yeah, so we do adjust for inflation. So we say, let's take it as at a 2-month you know interval and compare with the previous year. And then we adjust according to what's changing in prices, right? So if prices are up 3%, you're going to pay 3% more right across the board, even if, that baseline. Adjusting for inflation. Those are how we always look at that to try to make sure we're doing an apples to apples comparison. So great follow-up question.
Looks like we have another one that came in. This one's coming from Daniel. I believe he's saying housing started crashing post-Great Recession and struggled at very low levels for the next decade. How much room to run in the multifamily Class A rental market in growth markets before single-family housing supply catches up and demand destruction begins on the multifamily side?
Yeah, wow, that's great. So I blogged on this probably, it's been several months, sometime maybe the end of the last summer on multifamily. What I like doing, and our team here at LPL Research look at not only just the sales numbers like housing starts, housing permits, that's your construction side of things, and then you get to the sales, but also what's under construction, right? So just the ongoing units under construction. And as the questioner rightly noted, when you want to think about things, you have to think in relation to multifamily units. Incredible amount of activity. First time since the 70s where there's more multifamily units under construction than single family units. What I think that's going to do is, as more and more come online, that's certainly going to ease the rental problem, right? That's been the nagging problem from the headline inflation metric where you have rents being so high. So that's certainly going to be a help when that comes online. I think one thing to think about, and this is where it goes into investment opportunities. I think if you look at, say, like a Lennar or a Pulte or a D.R. Horton. D.R. Horton announced earnings yesterday. I believe they struggled a little bit, but overall, you have really an incredible opportunity for home builders because you have such low supply from existing homes, right? No one wants to move. I have a 2.5% mortgage. I am not going to want to move unless, we can somehow get to what was popular in my dad's era, which was, assumable mortgages, right? And there was actually, I think, a Wall Street Journal article recently on that. The idea that would be a pretty hot commodity, wouldn't it? But the point is, people are not putting their houses on the market like they normally do in a typical cycle, even in a cycle where we're at a late cycle, perhaps late cycle slowdown, risk of recession. People are not putting their homes on the market, and anybody who's interested or has to buy at this time, they're being nudged for obvious reasons into the new home market because of the supply constraint problem. And on top of that, these creative home builders have been able to basically say, look, we'll incentivize you by giving you a buy down, right? So maybe, mortgage rates are at 7, they're falling, right? We're no longer above 8%, according to bank rate, 30-year mortgage. We're close to 7. Well, what if a new home builder says, hey, I'll give it to you at 5.75? That's certainly going to be a great incentive. And so the point is that the big story is expect rents to fall because of the multi-unit activity, and expect opportunities to continue to expand businesses from a new home construction standpoint because of the low supply of existing homes on the market. I want to cover a couple different things, and then we'll get back to questions. But this is great. Keep them coming. This is nice. You're awake. That's good. Try to keep economics, less dismal and more hopeful, right? Economics is often called the dismal science because of Thomas Malthus, but I won't get into that. I think one thing we want to think about is, okay, the Fed's at this potential pivot, right? So hiking incredible speed. There was this warning from the chair talking about this potential for pain, meaning they've never hiked this fast before. We don't know what's going to happen. Could the labor market really crater and the economy crater? So far, so good. That soft landing narrative is there. So I think the key to think about where we are from this turning point, hence that first slide that Cameron, you started with, that thinking about the outlook for 2024. The turning point is this. The Fed is going to be able to think about, all right, inflation's in the right direction. Now, granted, prices are still high. Think about food prices. Think about restaurant prices. But the rate of change has decelerated. That gives them a little bit of leeway in order to think about a true pivot to cutting. One thing that is still, I think, a big unknown is job growth. And what I like to highlight, I always tell my audiences this, it's helpful to say, well, what is there that's a leading indicator rather than saying, okay, we know this happened last quarter. Well, that's great. But what about a leading indicator for next quarter? Well, I track a weekly statistic put out by the American Staffing Association, and they cover a number of industries across the U.S. And a very, very good stratified sample of what is happening from a hiring standpoint. We do see, as of the middle of January, that the American Staffing Association has seen some slowdowns in the hiring side of things. Now, granted, and this talk about a wrench to all this, we've had quite a cold spell, not just in the Southeast, but you had some storms even in Texas, right? Unseasonably cold weather in the Northeast. And what's interesting is those shocks, even weather related, do show up. So I think as we move through the month of February and we start getting data in for January, that's going to be a real interesting time. I think a key takeaway here is things will be a little bit choppy. We should expect that, not be surprised for a little bit of a choppiness when we have some, I think maybe some weaker numbers than expected because of the weather. So Cameron, I know I got a couple more questions, so I'll hand it to you.
Yes. So from Tim, here we go. Another one come in. How long can the Magnificent Seven continue to lead the market?
Yes. So 7, basically referring to the fact that when you look at equity performance last year, a lot of it was driven by a few tech names. Clearly the ones that are involved with artificial intelligence, the innovation that's happening in that region or that sector. And what we think, and this is kind of interesting when you think about it, when you think about those companies in the tech sector, we can often think of them as a growthy kind of sector, but also a value sector in the sense that they could actually do well in both a growing economy as well as a slowing economy. And I'll give it to you this way. Demographics are a key driver here. So just like the late 90s, we had a productivity boom that helped growth, helped us get through some recessions and through some tough times pretty quickly. I think we're at this point where, firms know this, but we're at a point where we need another spark to a productivity boom. And I think AI might actually do it for us. So next couple of years, we're going to have more Gen Z workers in the labor force than, boomers as more and more retire, right? As more and more people leave the labor force, but long life, a blessing of ours in this country, shifts the dynamics of who's in the labor force, who's working, who's generating productivity and generating value for firms versus who are now net consumers. And so I think the Mag 7, if they do it right, could actually be somewhat acyclical, meaning they're not counter-cyclical, but they're acyclical, meaning they could actually provide maybe somewhat of a support or a stabilizer even when there's some weakness in the economy. Cameron, we have some more questions.
Yes. So this next one comes from Linda, and she asks, any predictions on financial impact to U.S. citizens as we support the millions of immigrants who have entered the U.S. in 2022 and 2023 and the college loan forgiveness? Should we expect large federal tax increases?
Yes. Yeah. Well, the short answer is, yeah, my kids are going to pay higher taxes than I pay, hands down. Now my kids are 15 and 12. So you might say, okay, well, what if, let's do maybe a shorter forecast horizon than that. Yeah, I wouldn't be surprised in the next 5 to 8 years, we have this movement toward, just higher costs, particularly from our, the shift in how the federal budget is managed. Of course, managing through that, higher taxes, I think, are a thing to accept. By the way, I know I'm speaking to not only just end clients, but perhaps wealth advisors that are on the line as well. When you think about the changing dynamics, whether it is opportunities in the market despite choppiness, or whether it's how to prepare for a tax environment that's higher, it really does enforce the value of a financial professional. I think we can agree on that. Someone to walk alongside a shrink, if you will, right? Where to, bounce questions, think through things, different scenarios. But certainly it calls for someone to walk alongside your average investor on that. I think the first part of that two-part question was on the immigration side of things. It's fascinating when you think about what can immigration do well for an economy versus what it can do poorly. So I track this. This is really getting in the weeds, but you can actually dissect the foreign-born folks that are not in the labor force in our monthly non-farm payroll report. So this is, again, just deep breaths here. We're getting in the weeds, but it's worth it. So first Friday of every month, the Bureau of Labor Statistics releases this non-farm payroll report. Hits major networks, across the globe. Truly, very important. We get our unemployment rate out of that. We get a good read on labor force participation, how many people are working. But you can actually get some really nice granular data on who's not in the labor force by age, by even by ethnicity, all kinds of things. Anyway, so it's fascinating. In the last labor report, we've never seen a higher percentage of foreign-born individuals that are not in the workforce. Granted, that's not good. I think immigration can do great things for our country. Case in point, remember in previous decades, thinking about when the economy's humming along a little bit better, number of industries that immigrants tend to gravitate toward before we do, before the American-born. Speaking for myself, as American-born, my wife's an attorney, corporate attorney, does a lot of corporate work, and she can vouch for that. So I think at this point, immigration can do things well for an economy. At this point, we're probably at the category of immigration not doing good things for our economy, given that statistic that I just mentioned from the latest non-farm payroll report.
All right,
Question.
we had two more that came in, and just keeping track on time. We have just about I would say 5 to 8 minutes. We want to give some people time back in their day and stay underneath that hour. But an additional question comes from Richard. Although homeowners are not directly impacted by the rise in rental expense, would you please share your thoughts on rising homeowner expenses? So, for example, property taxes, energy costs, maintenance, and how much they potentially offset inflationary differences between homeowners and renters.
Yes, yes, yes. Great question. So services, particularly in insurance, financial services, has been a nagging problem for the last year. Interestingly enough, we track this deceleration pattern, as I highlighted earlier in the call, that's giving the Fed a little bit of leeway to say, okay, I think we've hiked enough. Inflation is coming down. Well, there are a few categories that have quite a challenge, and that is insurance, financial services in general, and of course, healthcare. If you wanted to check me on this, you can fact check me. When you look at the spending numbers as it relates to the inflation pressures, we actually have a really good handle on the weight that it is on your average household. So even when you adjust for homeowners versus renters, it's still so the insurance side of things certainly going to be a shock. In fact, North Carolina is hearing arguments from the insurance regulators even this week on what they're going to do in the coming years, allowing for an increase or not on home property insurance. That it will be a factor. Granted, that will be a factor across the country. It's not big enough, I don't think, in order to really be a sizable long-term headwind. People adjust. I can say this too. Gas prices, right? A lot of times, people will respond to the incentive or maybe an appetite for restaurant spend based on gas prices. In fact, gas prices is a very good predictor of consumer confidence, even though we don't spend a large percentage of our budget on gas prices. I think flip side here on the insurance side, perhaps even though it's not a big percentage of our budget, when you adjust even for homeowners, I think there is enough psychologically to do things like gas prices, but I don't think long term it will be a major impact. I think the things that I'm looking at, I think that are the biggest drivers here, wage growth, right? How well does wage growth keep up with inflation? And that supports the consumer spending side of things. So those are kind of the bigger categories where you want to weight those heavily relative to some of those other categories. Want to talk a little bit international, but I know we got a couple more questions. I think it's worth at least talking about domestic versus international, just because there's so much going on in China. But go ahead for a couple more questions.
Yeah, I think we have time for maybe one more chat question, then definitely want to get to your topic, Dr. Roach. But so the last chat question, based on your understanding of market forecasts, how would you advise retirees on the timing of annuitizing their investments for supplemental retirement income? Should they wait for funds to grow? Are losses expected in 2024 and following?
Well, I'll play up that word. Should we wait? So I am a father of a teenager, and I'll tell you that I talk to him. He's 15. I tell him all the time the value of patience. uh, and I think all the parents here in the virtual room could appreciate that. The value of patience, because in this case, talking about when to take distributions and when to think through work. I'm assuming you're talking about distributions from an annuity and other financial products. The value of compounded interest, right? It's always better to wait. In fact, I was just talking to my 15-year-old last night. He gets this email, hey, for the next 48 hours, you get this discount, but it only works for 48 hours. I said, Martin, don't fall for it. 48 hours can pass. Give it a day, you'll get another notice that for a short period of time, you're going to get, an opportunity that you'll have this discounted, coupon. If you can wait. It's always worth doing that. Now, granted, don't know your specific situation, but certainly worth talking through with a financial professional that knows your specific needs on that. Let's talk global just briefly, because I think this is really important, especially when you think about allocation from a portfolio standpoint. I'll give you the punchline. We're domestically focused right now. We have a bias toward domestics. We do see some growing opportunities in Europe, and Asia and Latin America, but when you adjust for the risks, you have inflation problems a little bit harder in Europe. They're more susceptible to shocks from China, shocks from Eastern Europe. Of course, you see China slowing down pretty dramatically because of a fairly weak property sector, uncertainty about the consumer side of things. We're domestically focused, and the reason for that is this: whenever there's uncertainty, we call it a flight to quality or a flight to safety. That's kind of the words that traders use on a trading floor. Flight to safety, flight to quality. The recipient, the beneficiaries of that flight to safety, flight to quality, dollar-denominated assets or U.S. dollar itself. Hence the reason why the dollar has behaved in recent years as it has. So I think that's just very important. I at least wanted to cover that. Again, I said there's 1,001 things to think about, but I think it's worth remembering when there's that uncertainty, choppiness. We think at this point it's worth having a domestic bias in the allocation. Cameron, we covered a lot.
We did. Thank you to everybody who submitted those questions. Thank you, Dr. Roach. I will actually pass it over back to Eric for some closing comments as we wrap up this webinar.
Great. First, Dr. Roach, thank you for all the great information today. We definitely appreciate it. I know our clients appreciate it as well. So thank you for coming on. For the clients on the call today, again, we appreciate you hopping on, listening to some of this great content from Dr. Roach. If you have questions on how it specifically, how some of these items interact with your portfolio or how they will affect you personally, it's best to set an appointment with your wealth advisor. Come on in, have that one-on-one conversation where you can really talk through some of these items and how it'll affect you, and if there should be something done with your portfolio. So they're happy to have those conversations. Your wealth advisor also does have a line to LPL Research, Dr. Roach and his huge team. So if you have questions, they can also send in some questions as well and get some answers back on some topics. So again, engage with your financial advisor. They're there to help you. For those of you that haven't done a comprehensive financial plan, financial planning is also a good roadmap to see where you're at now and where you'll be in the future. Again, we can't predict everything, but we can put some guardrails and see how your portfolio would react one way or another. So again, Dr. Roach, thank you for your time today. Appreciate everything that you've done for us here at Old National. And again, everyone here, thank you very much for joining the call today. Have a great day.
Thank you.